Good afternoon, everyone. Welcome to the latest of our Lunch and Learn series, where we will discuss the various measures contained in the Finance Bill, which was published yesterday. Many of the provisions contained in the Finance Bill relate to the taxation measures already announced by the Minister for Finance in his budget speech last week. There are also a small number of measures in the bill not previously announced in the budget, some of which we will discuss this afternoon. I'm delighted to be joined by a number of my colleagues who will walk us through some of the key measures contained in the bill. Oliver Donoghue will run through the various employment tax measures, while Jacinta Shinnick will run through the various measures affecting SMEs and entrepreneurs. Philip Murphy will address the various corporate tax and miscellaneous measures contained in the bill. And finally, Edna Kennan will run through the VAT and excise duty measures which were contained in yesterday's bill. Before we get started, I'd like to go over a few housekeeping items so you know how to participate in today's event. At any time during the webinar, you'll have the opportunity to submit your questions to today's presenters. To do so, just type your question into the Q&A at the bottom of the control panel. As time allows, the presenters will address as many questions as they can during the Q&A session at the end of the presentation. We will be recording this webinar and will share the link with everyone afterwards. Without further ado, I'd now like to introduce Oliver Donoghue, who will run through the various employment tax measures. Enjoy the presentation, everyone.
Thanks, Brian, and good afternoon, everyone. So the bill was quite light from an employment tax perspective this year, but there were a couple of changes in relation to employer reporting requirements of certain employer share incentive schemes that are worth noting. So currently, where an employer provides certain share-based remuneration to its employees, there is a requirement in the law to report certain details to revenue on an annual basis by 31 March following the relevant tax year. The bill provides that the reporting of these arrangements to revenue must be carried out going forward electronically. And the schemes covered by these updates are convertible securities, restricted shares, and forfeitable shares. It's worth noting that to date, the revenue has not provided a form for employers to use to report these share details. So in practice, this reporting requirement hasn't been enforced. The bill also extends the scope of broader share scheme reporting requirements to include awards in the form of a cash equivalent to a share, or where a discount on shares is provided to the employee or director. So again, historically, this there hasn't been any specific form to report these details of normal kind of share awards or RSUs to revenue. So this technical requirement report, again, hasn't been enforced to date. But we do understand from revenue that they do expect that there will be one new electronic return incorporating all of the reporting requirements under the sections that I've mentioned. So we do await further details to come from them on this. So if we move on then to the next slide. So many of you will be aware that a facility was introduced some time back to allow corporates to effectively warehouse any unpaid PAYE, PRSI and VAT debts with favourable interest arrangements for a particular period of time. So the Finance Bill now provides a legislative basis to extend this debt warehousing scheme to self-employed individuals as well. So for self-employed individuals, the scheme will effectively cover the balance of any taxes due for 2019 and preliminary tax liabilities for 2020. So both of these liabilities would be normally becoming payable over the next few weeks, either the 31st of October or the extended deadline of 10th of December, which is applicable to those who pay and file on ROS. So under this debt warehousing scheme, the self-employed taxpayers will effectively be allowed to defer payment of their income tax liabilities for up to a year without interest applying. And thereafter, a reduced 3% rate of interest will apply to any outstanding liabilities, which is a significant decrease from the existing 8% interest rate that would apply. The bill does provide that only those individuals who expect that their total income from all sources in 2020 will be less than 75% of their 2019 income as a result of COVID-19 restrictions will be eligible for this warehousing. And it does seem that these restrictions are intended to mean Irish government restrictions as opposed to any other global restrictions that might have impacted an individual. Also, in order to qualify, the individual must have met their 2019 preliminary tax obligations. Helpfully, the bill also provides that similar warehousing will be available in respect of 2020 balance of tax and 2021 preliminary tax payments if the individual can make a similar declaration that they expect their 2021 income to be less than 75% of their 2019 income as a result of the COVID-19 restrictions. So to apply for the scheme, the relevant individual should make a declaration as part of their tax return, whether that be the 2019 or the 2020 tax return when the time comes. And if it does transpire that the declaration the individual made is incorrect, then full income tax liability will be deemed to be due on 31 October of the relevant year, and interest at the normal rates of circa 8% will apply. The scheme won't impact an individual's ability to get a tax clearance certificate, and it is worth noting that the bill doesn't provide any provision for the warehousing of the CGT liabilities that will be falling due either on the 15th of December or 31 January in respect to 2020 capital gains. The bill also helpfully extends the availability of the debt warehousing scheme to repayments due to revenue under the temporary wage subsidy scheme. So many of you who are or have availed of the temporary wage subsidy scheme in relation to employees will be aware that in most instances there is probably going to be subsidies due back to revenue, given the fact that in the initial phase of the scheme, revenue paid a flat €410 to employers in respect to all eligible employees. So like the existing debt warehousing scheme, the finance bill effectively now will allow employers to defer the repayments of those subsidies at favourable interest rates. And again, you know, this entitlement to the warehousing of these subsidy debts, let's call them, is kind of an automatic entitlement for small and medium enterprises who are dealt with by either Revenue's business or personal division without revenue approval, but kind of any other employers will actually need to go to Revenue for approval where they believe they are unable to repay the subsidies at the due time. Just on the next slide then, the bill just does include a couple of small technical amendments with regard to the calculation of interest applicable, where the employer meets the requirements of the debt warehousing scheme. Effectively, the initial legislation didn't allow for interest to be calculated on a reducing balance basis. So now the revision ensures that account is taken of any payments made by an employer to reduce the debt in calculating interest payable. So we just move on to the next slide then, just in terms of the employment wage subsidy scheme. So the bill did provide for an update to the scheme. So, you know, many of you will be aware, as there was a lot of kind of media attention at the time when EWSS first came out, that the original legislation did exclude proprietary directors of a company from participating in the EWSS. And Revenue had subsequently then announced that the scheme would in fact apply to these individuals where certain criteria were met. So effectively now the Finance Bill is giving legislative effect to this change. And in order for a proprietary director to be eligible, the employer has to ensure that the eligibility criteria of the employer is met, as would normally be the case. The proprietary director themselves must be on the payroll of the eligible employer and must have been paid wages which were reported to Revenue through the PAYE system at some stage between 1 July 19 and 30 June 2020. It is worth noting that the proposed legislation does confirm that where an individual is a proprietary director of 2 or more companies, a claim for EWSS can only be submitted in respect of 1 company. So just moving on to the next slide then. So while not specifically dealt with in the Finance Bill, it is just kind of worth noting a couple of additional updates that have been announced this week in relation to the EWSS. So firstly, the Minister for Finance would have announced increase to the rates of subsidies payable last week. So Revenue have now kind of issued a press release to confirm those increased rates, which will apply for pay dates on or after the 20th of October, running up to the 31st of December 2020. So this table here just shows what the new rates are depending on an employee's gross weekly pay. But effectively, what the revised rates are doing is increasing the maximum subsidy payable, which was currently €203, up to €350. So the intention here really is to bring the payments under the EWSS in line with the payments that are currently being paid to individuals claiming the unemployment pandemic payment. So if you take, for example, an employer who is currently availing of the EWSS for an employee on a weekly wage of $350, prior to the changes announced, they would have received a maximum subsidy of €203. So with effect from 20 October, this subsidy in this case will go up to €300 per week, which is, you know, definitely a welcome increase for many employers out there. So just moving on to the next slide. One kind of significant cash flow concern that existed for employers availing of the EWSS so far has been just the time lag, or the waiting time to actually receive payments of the EWSS from revenue. So when the scheme was first introduced, the legislation provided that payments would be made to employers as soon as possible after the 14th of the month following the month in which the employees were paid. This was a significant delay when you compare it to the timing of payments under the TWSS, whereby typically refunds were paid within a week of employees being paid, if not shorter. So in a welcomed announcement on the 6th of October, Revenue did announce that they would bring forward the date for EWSS payments to the 5th day of the following month rather than the 14th. And effectively, you know, they are going to be making payments by the 5th of November for any payments made to employees on or after the 20th of October, you know, which is a significant difference. They have also helpfully confirmed that they are working at shortening the EWSS payment timeframe further. So EWSS payments in respect of November payroll will be made in early November rather than by the 5th of December. And thereafter, they'll, you know, their aim here is to try and get the payments as timely as they were for the TWSS. So just moving to the next slide then. So, you know, in terms of employer eligibility, just the next slide, thank you. In terms of employer eligibility for the EWSS, the employer had to be able to demonstrate a 30% decline in turnover or customer orders between 1 July and 31 December of this year. So there were perhaps a number of employers who, when the EWSS came out, weren't comfortable that they would meet that criteria. But, you know, now that unfortunately we are back in lockdown with level 5 restrictions in place, we would recommend that employers who haven't previously availed of the EWSS to kind of revisit their projections in terms of turnover and customer orders for the rest of the year now, to see in fact if that 30% threshold will be met. It is important though that you just to remember that you cannot backdate the EWSS, so it will only be available in respect of any pay dates on or after registration. And just on the next slide then, just to touch very briefly on the pandemic unemployment payment. So the bill provides a legislative footing for the tax treatment of the pandemic unemployment payment to basically confirm that it'll be liable to income tax in USC in the same way as other social welfare benefits, such as illness benefit and job seekers benefit. The extent to which an individual will actually pay any income tax in USC on it, though, will ultimately depend on their income levels in 2020 and you know, their own personal tax circumstances and tax credits, etc. But in January 2021, anyone who has received the pandemic unemployment payment, and similarly to those who would have received the subsidies under the TWSS, they will receive a preliminary end of year statement from Revenue through My Account. And if there's any tax due, then the individual will have the choice to either settle the liability in full or in part, or alternatively, Revenue will collect the underpayment by reducing the individual's tax credits over a 4-year period commencing in January 2022. So just moving on to then my last slide. So this isn't finance bill specific relation, but just to flag that Revenue did yesterday issue updates to their e-working guidance. So the Minister for Finance in his budget speech would have referenced some of the measures of relief that are available in order to support remote working. So Revenue have issued some updated guidance that's worth taking a look at. But effectively, a couple of the things they're confirming is that employees should not claim an income tax deduction for certain capital items that they would buy themselves, such as office equipment, office furniture, laptops, etc. Also, just to confirm that employees can claim relief for 30% of their broadband costs for the duration of the pandemic. Now, still remains to be seen as to what the duration of the pandemic means, but the guidance does kind of give some information around how employees might go about calculating the relief that's due to them. One kind of noteworthy point is in relation to the normal place of work. So Revenue have stated in their guidance that where an individual is working part-time in the office and part-time at home, their normal place of work is still the office. And likewise, when they're working full-time from home, their normal place of work is still the employer's premises or office. So that is important to note just in terms of kind of reimbursing employee travel to and from the office/workplace. So with that, I'm going to just pass you over to Jacinta Shinnick. Thank you.
Great, thanks, Alice. So I'm going to begin with some reliefs which are focused on SMEs and entrepreneurs. So the COVID Restriction Support Scheme, or the CRIS as it's known, is a much publicised budget day announcement, and that was legislated then for in Finance Bill 2020. So the CRIS offers a weekly cash payment of €5,000, so it's a liquidity lifeline for businesses whose turnover is severely restricted by COVID-19. The CRIS operates alongside the employment wage subsidy schemes that Olive just spoke about, but it's important to remember that they do have different qualification criteria, and in some cases, particularly around the drop in turnover, the CRIS is more onerous to qualify for. The scheme applies to individuals, companies and partnerships which carry on a trade. And the requirement regarding drop in turnover is a requirement that is based on 2019 turnover, so effectively the weekly equivalent of that, and it's a question of whether that turnover has experienced a drop of 75% or more. Again, just important to note that that 75% threshold is a tweak from the budget day announcements. So the scheme has been widened out a little bit in terms of application. Previously on budget day it was announced that there would need to be an 80% minimum drop in turnover. So just to give kind of an example of how the scheme might operate, so say you have a business which had a 2019 turnover of 520,000. We consider what the weekly average turnover would be, that would be 10,000. If that business has to shut, for example, because we're in the current level 5 restrictions, then that business would look at the weekly average turnover that it had for 2019, that's 10,000. It takes 10% of that amount, 1,000, and it can claim then the CRIS payment for 1,000 on a weekly basis for the period that it's shut due to those COVID restrictions. There is a maximum, as I say, 5,000 weekly amount, and that kind of is based on a turnover of 4.2 million. So again, if it's the case that the business has a turnover of 4.2 million or above, in most cases for 2019, that business will be capped out at that 5,000 weekly amount. The payment is called an advance credit for trading expenses. So effectively, it'll be treated like a taxable grant when it comes to completing that business's 2020 return. The CRIS is due to operate from the 13th of October through to 31 March 2021, but there is provision there for that to be extended through to the end of 21. And it should be a case that the claims process will be up and running from mid-November. There is an 8-week window then from the period that the restrictions kick in to actually go and claim the CRIS payment. In advance of the finance bill being published this week, Revenue did publish some guidance which actually provides some very useful worked examples. And again, that's a good point of reference if you are interested in the operation of the scheme. Again, just a caveat that the guidance issued by Revenue is based on the earlier announced drop in turnover threshold of 80% rather than the current 75% for the bill. And again, that guidance gives some good examples around how the scheme operates, where you have multiple business locations and some might be open, some might be closed. As with the wage subsidy schemes, then the recipients' names will be published. Moving on to the next slide, which covers CGT Entrepreneur Relief. So again, as announced on Budget Day, CGT Entrepreneur Relief is not only going to be retained, which is obviously welcome, but it will be enhanced slightly as well. So for those of you familiar with the relief, CGT Entrepreneur Relief offers a special 10% CGT rate for entrepreneurs who are disposing of qualifying assets, and those assets might include shares in a company. There has been a requirement that where a disposal of shares in a company, that minimum 5% of the company is held by the individual for 3 out of the last 5 years prior to the disposal. And in some instances, it was found that that actually was, I suppose, leading to some instances of where people were choosing to actually sell out entirely and, you know, sort of, let's say, resist diluting their stake in the business rather than take on sort of funding rounds that might actually help drive and grow value in the business. So the budget announcement, and again consistent with the changes that have been made in the finance bill, is that the holding period requirement, so that requirement to hold 5% of the shares for 3 years, that can be met at any time. So again, that's kind of a very welcome to see change. Again, as we would have noted kind of earlier, it's very much the case that all of the other conditions for the relief remain in place. So including, let's say, that condition around at least 50% of working time being spent in the business for 3 out of the 5 years prior to disposal. Moving on to the next slide. So when we think about entrepreneur relief, sometimes we might kind of think about matters relating to succession, and there are some succession related measures in the bill. So for individuals who are looking to claim relief from gift or an inheritance tax, so capital acquisitions tax, on a transfer of a business or agricultural property, those claimants often benefit from CAT agriculture relief or business property relief. Previously, it was the case that a CAT return didn't need to be filed for all claims. It depended on value or other different circumstances. Interestingly, we do see revenue reviewing a lot of these claims, and now the bill actually includes a measure to ensure that a CAT return must be filed for all claims for CAT business property relief and CAT agricultural relief. There are also some tweaks around time limits for review, for revenue's window of opportunity to review a return or to make inquiries. And again, this is to standardise what we have as our 4-year time limit for that. So for example, if I deliver a CAT return in 2020, the period open to review the return is until 31 December 2024. Again, that's just to standardise the period. Previously, it was by reference to the date that the return had been delivered. Finally, we've got stamp duty consanguinity relief. So again, this is a relief which is relevant to transfers within a family of certain farmland property. So that relief, which provides for a 1% stamp duty rate instead of the usual 7.5% rate, that was due to expire, but it's now been extended for a 3-year period through to 31 December 2023. Moving on to the next slide. So again, just to do a quick review of a couple of other changes which are relevant to SMEs and entrepreneurs and other business owners. So we are looking at the earned income credit. So the earned income credit has been increased to €150, and in a nice surprise, that benefit kicks in from 2020. So again, a small increase, but as part of an ongoing measure and ongoing, I suppose, process of work, to bring the taxation of self-employed individuals in line with employees. We also see some changes around, or at least being flagged, in relation to professional services withholding tax. The professional services withholding tax is a 20% tax which is operated by government departments, by state and semi-state bodies, by the HSE and others for payments for professional services. So that might capture doctors, dentists, solicitors, accountants, engineers, architects, a whole bunch of providers. So we see now that there's a measure flagged to modernise the PSWT regime, and again, that's a very helpful development. We've seen the benefit that the electronic modernisation process has brought to RCT, and again, PSWT being very kind of paperwork heavy, we would hope that this would help sort of bring about, sort of a more timely availability of reliefs and credits for PSWT that's been deducted. Finally, the Help to Buy regime has been extended for a further year. It was due to end in 2020. It's now been extended through to 31 December 21. And finally, so moving on to the last of my slides, there are some measures in relation to disposals. So again, these would be measures that would have been announced on finance on budget day and enacted through financial resolutions, and these have now been legislated for in the bill. So again, both these changes come into effect for certain transactions on 14th of October 2020 onwards. So the first one relates to foreign currency bank accounts. So typically, transactions in foreign currencies, so for example, sterling or dollars, and that would include withdrawals from foreign currency bank accounts, give rise to a taxable gain or an allowable loss from a CGT perspective. And that would be based on foreign exchange rate movements often. So this measure seeks to ensure that where you have transfers between foreign currency bank accounts, but those foreign currency bank accounts are owned by the same person, and effectively those transfers don't give rise to any economic capital gain or loss, that there will likewise be no CGT allowable gain or taxable gain or allowable loss. And again, that applies from 14th of October 2020. Secondly, we've got the specified intangible asset regime. So again, Ireland's intangible asset regime, or the 291A regime, as it's commonly known, allows companies to claim capital allowances on certain intellectual property assets. Those intellectual property assets, those Section 291A assets, were subject to particular rules around a clawback of allowances on a disposal or another event. For example, the asset ceasing to be used in the business. And that clawback of allowances or balancing charge event could only happen within a particular 5-year window. So the change that was announced on budget day and is now provided for in the bill is to apply, I suppose, or standardise the balancing charge regime as it applies to the 291A assets, and effectively for assets where you have expenditure incurred on or after 14th of October 2020, there will be no time limit for when a balancing charge event can arise. So that's, I suppose, a quick sweep through the various. I'll now hand over to Philip to tax measures.
Thanks, Jacinta, and good afternoon, everyone. So lots of small changes on corporation tax in the finance bill rather than any big legislative momentous changes. So I'm going to spend a bit of time just quickly running through the various measures. Starting with some relief, some existing relief regimes. On the kind of the green agenda, energy efficient equipment, there's been relief in legislation for a number of years now that gives you kind of full relief for spend on energy efficient equipment once it falls into certain criteria. That's just being pushed out now and continued out to December 2023. It was due to expire at the end of this year. Not in the finance bill itself, but announced on budget day, the criteria to be considered energy efficient is going to be reviewed just to make sure it's up to date in line with the changes to standards and so on. But it's an extension out of that relief. Similarly, on a kind of green type issue, business vehicles, there's been legislation in force for a number of years now for claiming capital allowances where you buy or hire a vehicle for use in your trade. And probably it's gone back to since the Greens were last in government. The amount of allowances you can claim, capital allowances, is linked to the CO2 emissions. So if you've got a kind of gas guzzler, it's going to be less allowances available relative to something that's very environmentally friendly. The only change, that regime is staying the exact same the way it was. They're just updating the categories of CO2 emissions to bring it in line with the new EU emissions regime. So maybe a little bit of a difference for spend on or after 1 Jan next year, where you are acquiring assets, motor vehicles for use in the trade. Lastly then, knowledge development box, no change to the regime, just kind of as announced in the budget, it's going to be pushed out for another two years to 1 Jan 2023, which is positive. So nothing changing on the conditions there, it's just extending out the relief. Next on the next slide then, I'm going to just touch on transfer pricing, which had a bit of an overhaul last year. Ireland's transfer pricing regime was modernised and updated in last year's Finance Act. And that modernisation and update, what it did was remove some of the exceptions and exclusions that were there in the existing legislation, right, including grandfathering, took out non-trading transactions as well. But it did introduce a concept of a domestic exemption, so an Irish to Irish exemption. And like it wasn't a blanket exemption. There was lots of, once you get into the detailed conditionality around, whether an Irish to Irish transaction could qualify for exemption and be outside the scope of transfer pricing. And kind of a bit of the history on it is the legislation didn't quite cover every arrangement that one would expect to be outside the scope. So, for example, interest-free loan arrangements from a kind of non-trading parent to a trading sub were potentially within scope of the transfer pricing rules. And there's been lots of discussions with revenue. There's been draft guidance in the offing for a number of months now, which practitioners have fed into. And really what they've done in the finance bill this year is try to put some of the issues that have been teased out as part of that process on legislative footing, right? So the legislation that was included in the bill is quite clear now that interest-free loans to trading or Case 5 companies will qualify for the exclusion and be outside the scope of transfer pricing. There are some conditions, right? But it's a lot clearer than it was before. Unfortunately, the way that they've changed this, they've kind of scratched out completely what was introduced last year and dropped in a whole new section. And in doing that, I think they've potentially brought in scope certain transactions which would have been outside the scope previously to within the scope now in the manner in which it's been legislated for. For example, outside of loan arrangements, there's a concept that where there's a transaction between two Irish parties, it can only qualify for exclusion where there's a nominal amount of consideration charged for the service. So things like free use of property would potentially be getting brought in to scope with the transfer pricing rules, and it's not clear whether that's intended or unintended. So on transfer pricing, I suspect as we move through committee stage and onwards, there's going to be a bit more discussion, a bit more dialogue, and potentially some changes just to make sure that Irish to Irish exclusion operates as it should and captures all the arrangements that it needs to. Moving on to the next slide then, got to focus on some of what I'd call the EU developments that have been dropped into Irish legislation in the last few years. So we've got the EU Anti-Tax Avoidance Directive and then EU Mandatory Disclosure, which is more commonly known as DAC 6. And really what's happened, legislation has been dropped in over the last couple of years on those various directives. And what we're seeing this year is rather than anything fundamentally changed, just minor tweaks or nuances to make sure the legislation works as it was intended, or to make sure that there's absolute clarity on when the rules apply or when exclusions apply. On CFC, which was introduced in last year's Finance Act, that can give a CFC charge for an Irish company where it has a foreign subsidiary entity. There's a whole laundry list of exclusions and exceptions that could potentially prevent that CFC charge from arising. And what this year's finance bill does, it says, well, if you've got a subsidiary in an EU blacklist territory, it can't qualify for some of those exclusions. And that includes the effective rate one, things around the profits that you have, the profit margin test as well, right? So it's based on the updated EU blacklist, so it doesn't cover Cayman subsidiaries, given that Cayman Islands was taken off the blacklist. It would cover things like Panama, Anguilla, I think Fiji's on there as well. So probably not going to have widespread impact, but it's one to bear in mind. Anti-hybrid rules is a relatively complex piece of legislation introduced in last year's Finance Act. And really what we're seeing this year is minor technical changes, right, to make sure it's very clear what's in and what's out of scope. And to be honest with you, the changes are quite helpful in terms of ruling things outside the scope of the rules. An example is the associated enterprises test, where there's been clarification introduced in yesterday's bill to say, well, if you were associated with somebody, but you're not associated at the time you make a payment or take a tax deduction, well, then it's not in scope of the anti-hybrid rules. It also kind of clarifies if you've got a kind of looking at a hybrid entity arrangement, if you make a payment to a hybrid entity and the ultimate participator in that hybrid entity is a tax exempt entity, that will be considered included and outside the scope of the rules. And that kind of aligns it with other mismatch provisions in those rules. So all helpful on the anti-hybrid front in what was announced and introduced yesterday. Exit charge legislation was brought in by the budget that preceded the Finance Act 2018. And really what it does is it imposes tax where you take certain assets outside the Irish tax net. It does allow you to defer the payment of that tax for 5 years on election. subject to the fact you have to pay interest where you do that deferral. And what the change yesterday does is just clarifies that if you are deferring and you are paying that interest, the amount of interest you paid relates to the total amount you owe rather than the next instalment due, right? It was flagged in the budget and clearly signposted at that stage. And then finally on the EU developments, EU mandatory reporting is something that will come sharply into the focus of people who have cross-border transactions as we approach the first reporting deadline early next year. What Finance Act 2018, Finance Bill 2019 is doing, sorry, what Finance Act 2019 did was introduce it. What Finance Bill 2020 is doing is making minor clarifications to how the regime is going to operate. Again, it's quite helpful in what's being introduced, in that the types of taxes which are in scope are clearly clarified and legislated for now. The types of transactions that are in scope, certain things are carved out of reporting obligations, particularly on Hallmark A3, which is standardised documentation. There's a list provided for now in legislation that says if you have standardised documentation on things like revenue approved share option schemes, well then that's not going to be reportable for under DAC 6. So quite helpful what's been introduced in the context of DAC 6 in yesterday's bill. Moving on to the next slide then, just going to cover off on some FS focused measures, some minor points, right, which will have impact on some financial services firms. First one is encashment tax, which is quite a niche area. Applies where somebody is receiving foreign source income on behalf of an Irish resident, like wealth managers and stockbrokers. And what's been done on encashment tax is there's an increase of the rate from the standard rate of income tax of 20% to the DWT rate of 25%. Now that's not going to cause an increase in overall tax payable by Irish individuals, because you get a credit for encashment tax ultimately, but it will have a cash flow impact, because instead of having 20% deducted at source by your intermediary, it's going to be 25% deducted at source in your foreign source income. Helpfully on encashment tax, there's been a carve-out introduced for Irish companies who are within the charge to Irish tax. And that just means that it's kind of positive from a cash flow perspective. Previously, those companies would have had to suffer the encashment tax and claim a credit in their CT return. So that is quite a helpful amendment that's been introduced. Payment card providers, there's been a provision for revenue to make regulations which would allow and require credit and debit card issuers to report certain data on cross-border transactions. So there's nothing in force yet on this, but the direction of travel is quite clear, right? We've seen this before with other legislative amendments. It's making allowance and allowing those regulations to be published. So if you're a credit or debit card issuer, it's one to be mindful of, because there may be reporting obligations coming down the line. Bank levy is something that's been enforced for a number of years, and there's a target annual yield of 150 million. The way it's calculated is based on the 2019 dirt that is collected by banks. So to make sure that the yield stays constant at 150 million, there's a requirement to increase the rate from 170% of the 2019 dirt to 308% of the 2019 dirt, just because the amount of dirt that was paid has clearly changed over the years, and they want to maintain the yield as a constant point. And then insurance, minor technical amendments, right, just to reflect the fact in various taxing provisions that are insurance focused that Ireland has actually transposed the Solvency II directive. So it's taken out some of the regulations that were there and putting in the reference to the Solvency II directive. On to the next slide then, which is the only Brexit related thing that was announced in the bill yesterday. And it's not on an indirect tax measure as you might have expected. As part of Brexit, Irish securities that are currently held in the CREST system, which is a UK system, will have to move to Euroclear, which is a Belgian settlement system. And what's been done in the bill is effectively trying to make sure that that transition of securities and the movement from CREST to the Belgian system won't have any major ramifications for taxpayers. So, for example, what they're doing on like DWT type reliefs, like the QI regime or the AWA regime, is just making sure that they're reflecting the fact that the securities now sit in the Belgian settlement system. In addition, there's absolute clarification being provided for that the migration of the securities won't be disposed of for CGT purposes, And then the Belgian CSD system has certain legal nuances in how it works, and there's clarifications, for example, that holding securities that are being held through that system won't give rise to the fact that you're going to have an investment in an offshore fund. So some to reflect the legalistics of how that Belgian system works. But on a kind of broad scale, it's making sure that the transition doesn't have any negative tax implications. Onto my final slide then, I'm going to just touch on some matters related to the Tax Appeals Commission and settlements. Firstly, there's been a broadening of the scope of when the appeal commissioners can dismiss a case where a party fails to adhere with certain things. So, for example, the submission of a statement of case. If that's not submitted on time, the appeal commissioners will now be able to dismiss a case. It seems like a bit of a one-sided change in that the appeal commissioners will be able to dismiss a case, but they won't be able to uphold a case based on the way it's currently drafted. So that's something where we might look to get a bit further clarity and changes as we move through to the Finance Act itself being passed into law. There's another provision on the appeal commission interaction that provides where an appeal commissioner vacates office between the time period when the hearing's commenced but not yet finished, or the hearing has been completed but a determination hasn't been issued. And where an appeal commissioner does vacate office in those circumstances, you effectively, once the new commissioner comes in situ, reset to day one, right? That might seem a bit unfair if you've gone through all the rigour of doing your appeal and all the process that's involved, but it also is a possible opportunity, right? If you haven't particularly made a great case, going back to stage one effectively allows you to remake your cases. So it's kind of pros and cons of what's been introduced there. And the genesis of it really is that we've got a number of temporary appeal commissioners now. So they're possibly going to rotate in and out, which is why that change has been introduced. Finally, the last point I'm going to make is around interest on settlements where there's a case at appeal. Appeals take a long time to come to fruition in some cases. So a lot of times what a taxpayer will do is pay the tax up front to stop the clock on interest. And the change in yesterday's bill is effectively saying that if you do pay that tax in advance and the revenue ultimately win, that you won't get interest back when revenue are refunding you the amount, right? And that seems very unfair, because if you don't pay the tax, you'll be liable to the interest. So it seems like a bit of a one-way approach, but that's the legislation as it was published in yesterday's bill. So that's a quick whistle-stop tour of the corporation tax and other miscellaneous measures. I'll pass over to Etna now on the indirect tax measures.
Thanks, Philip. So in looking at the indirect tax measures in the Finance Bill, I'm going to start with VAT. And a main theme of the Finance Bill related to VAT rate changes. And the first big hitter, VAT rate change that people will be aware of. Following the budget announcement, the Finance Bill is providing for this temporary reduction in our rate, primarily for the tourism and hospitality sectors, from 13.5% down to 9%. And this temporary reduction will be from 1 November until through to the end of next year. Really, the benefit of this won't be seen immediately because of our COVID restrictions. So right now, we're talking about your takeaway coffee, your takeaway meals benefiting from this. But as COVID restrictions lift, this reduced VAT rate is applicable, as I said, to a number of tourism and hospitality activities. So restaurant, catering services, hotel and guest house accommodation, and various admissions. So cinemas, museums, theatres, amusement parks and the like, as well as hairdressing and certain printed matter will also be benefiting from this rate. Although it's very helpful and very positive for businesses, any VAT rate change does pose challenge in respect of getting it in force and also any systems changes that need to be managed. So we're coming off the back of a reduction in the standard rate, very welcome, but businesses have been dealing with that. And likewise, a change of VAT rate in this area will just need to be managed. So in respect of that, our website has a number of practical tips and resources if you want to access those, to think about some of the systems changes and practical points to really manage this in the best way, this VAT rate change. Now, sticking with the same theme about VAT rates, the next one isn't so much a change, but a very helpful legislative confirmation of a revenue concession, where revenue had confirmed that the 0% rate could apply in the context of combating COVID-19 for supplies of equipment, say your PPE, to the HSE and other healthcare facilities. So we have a legislative basis for that in the finance bill, but because that will be running out at the end of this month, there's also provision that that will be extended beyond the 31st of October if the European Commission issues further notice permitting this. So we're still sticking with VAT rate changes here, but the next we'll go on to will come in from January. And these include, firstly, if I look at farmers, there's a slight increase from next year in the what we call the flat rate addition. That's effectively compensation. It's a nod towards farmers to recognise their limited VAT recovery, their restricted VAT recovery position on their costs. So their ability to apply their flat rate addition on their supplies of agricultural products, say, will be increasing slightly from the current 5.4% rate and up to 5.6%. And conversely, a reduction from January will relate to certain sanitary products. So whereas those certain sanitary products might be viewed historically as more of a luxury item, and as a result, they would have been standard rated, they'll be reduced down to 13.5% rate from January as part of these finance bill measures. Now, if I can move on to the next slide, and again, we're still looking at VAT. Another measure, this is moving away though from VAT rates, is more widely to do with tax representatives. So the finance bill is envisaging that revenue will have the power, and of course it'll be subject to conditions, but they can issue a notice. And the notice will be issued to non-Irish traders, requiring the non-Irish trader to appoint an EU-based tax representative. And if that arises, the tax rep would be dealing with the VAT payments, and also as a result would be jointly and severally liable for the VAT liabilities in Ireland. So we'll obviously have to wait and see how this is being applied in practice, but you'd envisage that we may see more of this come the summer of next year, because we will have across the EU a new set of rules coming in regarding online sales, digital sales of products. So we may see some more relevance or implementation of this then. And between now and then, we may see sporadic use of this, where in situations where perhaps revenue feel that they require extra protection and security in respect of the non-Irish traders' activities. Now, in the finance bill, there are a number of other technical measures. And in looking at those and wondering why Irish, there was a need to bring this in, really an aim is to try to bring the Irish VAT law more closely in line with the underlying EU VAT legislation. So among these various technical measures, one that I wanted to point to in particular relates to the holiday and guest accommodation sector, and especially bearing in mind what I mentioned earlier about the very welcome reduction in the VAT rate, albeit temporarily until the end of next year. Somewhat linked to that, the finance bill is taking a look at the definition of, well, what is holiday and guest accommodation, and broadening it somewhat, because in effect there's a withdrawal of the existing, some would say arbitrary, distinction in the VAT rate treatment of activities in the sector, depending sometimes on whether a stay is considered to be sufficiently short term. And in that context, we often call this the 8-week rule. So in other words, a distinction depending on whether the stay was under or over 8 weeks is being removed in certain circumstances. So that's relevant for that sector and can introduce a VAT charge on some activities that VAT may not have applied to previously. If we move from VAT, but on still this slide, to excise, as you'd expect, a finance bill will usually implement announcements on certain excise matters in the budget, and this is no different. So if we look at some of the recent budget announcements, we saw they related to carbon tax. So for example, the finance bill is providing for the expected increase in carbon tax, and in particular, the expected annual successive increases in carbon tax, because where Ireland needs to get to by 2030 is a carbon tax rate of €100 per carbon tonne that's emitted. And then on the tobacco front, we saw in the budget, and from budget day, and the finance bill provides for this, an increase in excise on tobacco, so that in effect, a packet of 20 cigarettes has an extra 50 cents if you take that into account into that figure. Similarly, the finance bill is dealing with the budget announcements about vehicle registration tax, VRT, and motor tax. So more particularly there, overhauling and changing the tables which enable you to calculate your VRT or your motor tax coming into effect from January. On top of that, though, the Finance Bill does have a supportive measure, and this would reflect the government's decision back in August to help support nightclubs and pubs and the like. So there is a waiver of the excise duty due on the renewal of certain liquor licenses for the licensing years 2020 and 2021. Now, if we move to the next slide, a remaining area in indirect tax is, of course, customs. And as Philip mentioned earlier, the indirect tax aspects of Brexit weren't addressed in the Finance Bill. We weren't counting on this because we are aware of a general scheme of an important 2020 Brexit omnibus bill, which is aimed at more fully addressing the indirect tax aspects of Brexit and which should be passed before the end of the year. Now, obviously, we have a bit of a moving feast here, but there are some features in that scheme that I think businesses should be acquainting themselves with. And some of these are positive. So if we look firstly at import VAT and the new reality that we'll be seeing import VAT applying for many businesses on the movement of goods into Ireland from the United Kingdom, bearing in mind that transactions with Northern Ireland will have a different protocol. But for movements of goods into Ireland from Great Britain effectively and also from other non-EU countries, import VAT at point of entry would be a great cause of pain. And we are expecting instead a simplification of postponed accounting, which would allow the VAT to be dealt with through the VAT return process and have those benefits from a cash flow perspective that's so important for businesses right now and into the future. That's the carrot. That's the positive side that we are expecting. But for every carrot, there is a stick. So it's important for businesses to be aware that timely reporting of the VAT through the VAT return will be very important. This is because regardless of whether a business operates with full recovery, partial recovery, restricted recovery, if you are trying to access the benefit of reporting your import VAT through the return, it'll be important to get that VAT correctly in that VAT return. If there's a failure to do so, in other words, a failure to correctly report that import VAT in your return, we are expecting a situation where you'll be viewed as having a VAT underpayment. And as a result, there could be potential penalties associated. So a bit of a mindset set shift will be needed and some systems issues will be necessary to be looked at in order to deal with those matters. Now, again, as part of this general scheme that we're expecting, there won't be any shock here. Of course, we'd be expecting enhanced customs enforcement procedures, additional powers for customs officers. But conversely, an expected benefit would be to have in the omnibus bill a legislative basis for more online services in respect of customs, and in particular to manage the roll-on, roll-off ferry movements of goods from the United Kingdom, not Northern Ireland, into Ireland. So clearly we're waiting to see more about the negotiation of a free trade agreement and so many other practical points that are of great interest and practical importance to businesses. So we will of course be keeping you updated on this. In the meantime, there is a number of resources on our website, including playbacks of previous webinars we have about the practical implications and checklists that businesses may want to be considering in respect to Brexit. And also, we're looking at having a webinar next month in order to keep you updated on these important developments. I'm going to hand back, though, at this stage to Brian, and in particular to see if any questions have come in about the content that's been covered so far.
Thanks for that, Edna. Yeah, so we have a number of questions which we will address. I think, Edna, sticking on the VAT side, a couple of questions have come in. Just in relation to the reduced rate for the hospitality sector, does the reduced rate apply to hotel spas, sticking with luxury good items?
Yeah, it can. I mean, I think the issue there is that in a spa, are we seeing also sales of retail sales, items that actually would have, which can be a big moneymaker, if you could actually get an appointment. But those retail sales that would always have been subject to VAT at the standard rate, what you're looking at instead is trying to access the lower standard rate. And as I mentioned, then hairdressing and that kind of thing will be able to access the 9% rate. So just because hotels, spas, they can have a range of activities, you didn't expect a number of them to be able to access the lower rate until the end of 2021. But just always watch out for maybe the exception. But if something was previously never getting the 13.5% rate, we're not expected magically to get the 9% one. So I think, and thanks to the person asking that question, it's as important to be aware that if there were items that never qualified for the reduced rate, there hasn't been a widening in that respect. It's just been to change those items that would have been at 13.5% down to 9%.
Yeah, and given the, I suppose, the application of the 9% rate to the end of December 2021, and we currently have a reduction in the standard rate from 23 to 21 up to the end of February next year, is there an expectation that the standard rate will, the reduction in the standard rate rather, will get extended to the end of December next year?
You see, although I'd love to be able to give some positive news at the end of this webinar, I mean, that's really not expected. That wasn't taken up as an opportunity in the finance bill, although, as you said, the reduced rate has been confirmed until the end of 2021. If I was signing a contract today, and I know I'm carrying out an activity that tracks a standard rate, it's more realistic to be building in, especially if you're dealing with a VAT inclusive price, the expectation that the standard VAT rate will move back up again from March. Having said that, never say never. So obviously we'll watch with interest, but businesses should be taking steps to protect themselves, make sure they can manage the VAT rate change, and prepare that as it stands, the VAT rate for the standard rate will be moving upwards at the end of February.
Yeah, perfect. Thanks for that, Edna. And Olive, just moving over to you, just in relation to the application of the employment wage subsidy scheme, just the timelines for the application of the increased rates. I think there's a question just, when is that timeline? Is it the end of December 2020 or actually is it January 2021?
It's January 2021, Brian. Yeah, no, it's from 20th October till 31 January. Now, remains to be seen if that will be pushed out again, but certainly that's it for the minute.
Okay, perfect. And in terms of the employment wage subsidy scheme, like it's been in place now a number of months. Are we aware of many taxpayers actually availing of this, or do we feel that the eligibility criteria is just too restrictive for people to actually qualify for this regime?
Yeah, so like I suppose like the latest stats that have come out from revenue, I think, show about maybe 39,000 employers I think have registered for EWSS, whereas this is compared to about 66,000 I think that registered for TWSS. So I think there's a couple of things with this, right? I think the biggest hurdle is the requirement to meet the 30% decline in turnover customer orders, looking at the period 1 July to 31 December of this year. So unfortunately, that kind of element of the scheme is a little bit disappointing because it doesn't give employers any credit whatsoever for the significant losses and hardship that they would have experienced in the first half of the year, and particularly kind of from March to June time. So I think that is kind of a big contributing factor, that it is really essentially requiring employers to suffer another loss, and a big one at that, on top of the what had happened earlier in the year. Also, I think employers are probably finding it a bit difficult to predict sales and turnover over the course of the 6-month period, because naturally we're in level 5 now, but could someone have predicted that 2 months ago? Potentially not. And the difficulty is, once you register, you can't backdate. So that kind of, I guess those restrictions can make it a little bit at least difficult to get the most out of the scheme, I guess.
Yeah, no. Very good. And you mentioned the level 5 restrictions that are currently in place. Obviously, the government would have introduced a relief or a credit for what we call staycation relief. Given now that people are on level 5, we can't actually avail of it because nobody can go anywhere other than 5k from their house. But is there any expectation that it would actually be extended? Do you know? Or
certainly, I don't think anything. Well, it wasn't kind of referenced at all in the bill anyway yesterday, right? But we would hope that something will have to be done on that, because the whole idea was to stimulate activity in the hospitality sector. And if we're all locked in our own counties and our own homes at the minute, obviously it's not going to achieve what it was set out to achieve. So maybe a bit of watch this space, and hopefully it'll be extended further in 2021.
Perfect, excellent. And Jacinta, just handing over to you, there's a question regarding if you're claiming expenses related to broadband, electricity, etc. Would that have an impact on your future qualification for principal private residence relief if you dispose of your house?
So I suppose the good news there, Brian, is that Revenue would have brought out updated guidance on e-working during the week. And again, that guidance would have clarified the position that there is absolutely no negative impact on PPR relief. So again, absolutely no worries or no concerns there from that perspective.
Perfect, excellent. And just in relation to the entrepreneurs relief, obviously there were some minor amendments introduced yesterday in the bill. So it's a question in, do you think the Department of Finance could have gone further to actually introduce measures that would make the relief even further, more attractive to taxpayers?
Yeah, absolutely, Brian. And I guess, that ranges from the small. For example, at the moment, there is a niggle there with the relief that if you've got a dormant company in your group, that compromises the entrepreneur's ability to avail of the relief. Again, that's a very small change, that would make potentially a big difference. So as I say, it goes from the small to kind of the bigger picture too. So one thing that we've very much been advocating for and would really welcome is an extension of the entrepreneur relief, not just to gains, but also to dividends that are taken from a company. And again, that's all about that piece of giving entrepreneur reward at a point in time of where, they can take some money out, get the beneficial 10% rate, but also, let's say, stay in and continue to grow and scale the business as well, that they don't just have to exit to get the 10% rate. That's something that we very much welcome.
Yeah, excellent. I'm conscious of time. There are a number of questions that have been sent in that we haven't had an opportunity to address, but given that we're coming up on lunchtime, what I'll do is the questions we haven't addressed, we'll send them around to people's relevant KPMG contacts and we'll let them address them that way, just as I said, conscious of time. So without further ado, I'd like to thank all of our presenters for their hard work in getting everything prepared overnight and presenting today on the various measures in the finance bill. I'd also like to thank all of our audience for participating today and just want to wish you all an enjoyable weekend and stay safe. Thank you very much, folks. Take care.